Well, welcome back everybody to the Blackfire Technical Analysis YouTube channel. I'm your host, Crypto Bro. We're back at it again with another instructional video. And today's video is going to be on the 21 exponential moving average strategy. But I know what you're thinking, Brian, you've already put out a 21 EMA strategy video. Yes, I have. But this is my complete understanding, my complete nuanced thought process on how I trade and how I utilize the 21 EMA. So we're going to be talking about way more than just the 21 EMA today. This video is going to have a lot of content, noteworthy content. I have a whole list here that I'm going to be covering tonight. There's going to be a lot of topics about this moving average strategy because there is a lot to think about when utilizing it. We're definitely going to cover everything here. So number one, boom, nice big old thingy right there. Time frame. I use 24-hour or the daily. Well, that's a question mark. I needed a slash. Why do I use the 24-hour time frame or the daily time frame? Well, this strategy has a 78% success rate. Statistically. Right? We can make that a little bit bigger. Boom. So that's why I use the 24-hour time frame. I'm gonna explain how to get this on the chart. Again, I do have a list. So first thing you're gonna do, you're gonna pull up your chart. Boom. I'm using Bitcoin for this entire video. There's plenty of examples that are very accurate, that are very tradable here on Bitcoin. We're going to go to indicators here. I'm going to give you guys the one I use. CT, moving average, crossover indicator. Boom. Community scripts, it's going to pop up. CT, moving average, crossover indicator by the_caretaker. Phenomenal indicator creator. The dude's awesome, and his moving averages are fucking awesome. Just click it. Boom. It'll pop right up on your screen. You can come over here, CT Mac, go to your settings, mess with what you want to mess with. But inputs, make sure you have the 21, and for later on in the video, have the red 10 available as well. Those are the only two moving averages that I'm going to be considered with. Like that's all I'm going to care about in this instructional video. More so the 21 than the 10. The 10 is just going to have a little bit of like a little entry, a little bit of an intro on how I use the red 10 in confluence with the 21 EMA. Again, I'm recording this video like it's live. I'm just gonna be me. And we're gonna cover all this shit here. Explain how to get the 21 EMA on the chart. Done. Show inputs. I think I just did that. You go to CT Mac, open up settings. You can go to your style, change the colors. Lots of stuff to play with. And then you can go to your inputs here. You can adjust them here. Make sure, if you're going to have the red 10 simple, make sure it's SMA. If you have the 21 EMA here, make sure the input's at 21. Make sure it's selected to EMA. Hit OK. Boom. You got yourself the 21 EMA. Order of operations. The first thing we need to do when using the 21, identify the overall trend. This means macro, not micro. Okay? Macro, not micro. What does that mean? We're not going to come in here and identify the trend just by looking at this little piece here. Just by looking at this little piece here. When in doubt, pull out. Look at the overall macro trend. It's going to give you inference, a lot of inferences on 21 place. Is the market bullish or is the market bearish? How the 21 works during bull markets. So how the 21 works during bull markets, here's a clean cut example right here. We come off this structure, come all the way down below the 21, which is a really good short trade. We'll get into shorting first, but boom, macro structure is still intact. Again, the macro bullish structure. There was a little bit of fear that this was going to switch into a full-blown bear market, but guess what? It didn't. It continued the bullish trend by confirming a macro low here. Again, overall trend is up. Overall trend is up. A little bit down here, but guess what? From a macro perspective, it's still up. The trend is still up, right? Uptrend. Macro, uptrend. Downtrend. We're going to see an example of a downtrend. We're going to see a really big example. Boom. Here's a bear market for Bitcoin. Series of lower highs and lower lows. This is a downtrend, right? All-time high, previously all-time high, new lows, flips, prints a lower high, flips all the way down, confirms massively new lows, flips, lower high, flip, lower low, flip, lower high, flip, lower low, flip, lower high, flip, lower high, consolidation, bear market. Series of lower highs and lower lows, right? We're not focused on the 21 right now. We're just focused on candles, price action, identifying the trend. This is how you know. You get a high, then you get a lower low, and then a lower high, and then a lower low, and then the downtrend continues onwards and forwards. That's how you identify a downtrend. Here's an uptrend. Nice little uptrend, flip to a nice little downtrend. Boom, another crash. This is the current uptrend that we are still a part of. It's very obvious that this is an uptrend, guys. So at the end of the day, higher highs, higher lows, right? From a macro perspective, I know this low was confusing at the time, but in confluence with the prior macro low here, it still holds. It still holds the macro bullish sentiment here. Even though we did see a collapse of structure, it confirmed a higher low right here and then continued the bull uptrend here. So you got to know the difference between the two. I'm not going to get too deep into how it works as far as trends are concerned, but I am going to include how the 21 works during these types of trends. So we're going to start with that downtrend first. Okay, so we do obviously we see a nice little bull market going on right here, right? And then we officially boom, we get a short signal right here, right? How do I know it's a short signal? I'll tell you. For those of you that know my streams, you've heard me say this constantly. When you're playing with an edge and you write it down in your rule book to stick with your edge, it is not an option if you want to be successful long term. If you want to be successful consistently over time, it is not an option. You must stick with your plan. If you plan to fail your plan, if you fail to plan, your plan is to fail. I almost said it backwards. If you fail to plan, your plan is to fail. And part of that plan includes executing your edge upon confirmation. How do we know that this is likely to come down? Number one, price action hits a blow off top, breaks below the 21, uses it as resistance. That's your short signal. Nice little fake out, right? Nice little fake out happened, but you see the slope is still negative. Even during that fake out, the slope never really increased in momentum. The slope stayed negative here. That's how you know that this was likely bullshit. And then boom, it rejects. Your signal was correct. Another fake out, but guess what? We hit resistance, which we'll get into in a little bit later. And then boom, your full blown signal here was pretty much level, pretty much the same as your entry signal over here. So you enter here and then you let this play out. You might have taken a loss. We're going to get into risk management and all that stuff, but if you're just trading it blindly and you're saying, you know what, unless I see some kind of reversal, I'm going to stick with the 21 to the downside. Sometimes it works, sometimes it doesn't. Most of the time it should work though. But in this instance, again, if you're playing it the way I play it, this wouldn't have worked, just because of the simple fact that I'm sure price action got 2% above the moving average here on the upside. But nonetheless, we come over here, we get our first official full-blown signal below the 21, initial break, boom, secondary candle closure, right? You're looking for a break followed by a confirmation candle. I'm going to zoom in. I'm going to zoom in real tight on this. You see an initial break of the 21 right here. This is not confirmation. It's just broken. It is a warning shot at best. Price action could easily have recovered back above the 21 the following day, which would have confirmed it as support still. It would have never flipped to new tentative resistance. But we get this secondary candle closure right here below the 21 EMA. That is your entry signal. Boom! And look what happens. Again, this is just trading it blind. You trade it blind, you ride that entry. Let's do a measurement. 54% to the downside. 54% to the downside is the possibility for profits. And again, we're going to talk about how to make that more than 54% over time. And again, just trading it blindly, there's a huge opportunity. And even on these little signals here, even on these little signals, you still have possibilities. You still have potential. Especially if you trade it the way I trade it, right? Trading it blindly, this is a bad, this is a bad entry here. This was a little bit of a fake because you would have got out at a loss here. And, kind of the same thing here. You might have gotten out at the loss. Not really a good example of a 21 EMA trade, but guess what? Look at the trend. You see the trend is already down, right? As soon as you enter this position here, you're like, oh man, this is big. Get that nice little fake out. People think it's going to get bullish again. Oh shit, we're going back to the moon. We're going back to $25,000, $30,000, which at the time was an unheard of amount. Double tops. Never really shows true momentum in the 21 here. Confirms the downtrend even more, and you get yourself another entry. Typically during bear markets, you can get some bullish momentum out of bear markets, but again, look at the overall trend. Lower high after lower high after lower low after lower low. The trend never reversed to the upside. So anytime I'm in a bear market, I'm looking for short plays to be a little longer and long plays to be very short, right? And it's the opposite for bull markets. I'm looking for long positions in bull markets to be very extensive, and short plays to be very short-lived. And again, that's the difference between a bull market and a bear market. And the current example right now, again, I am currently in a position on this 21 EMA play here. It has been very profitable, but I am expecting it to be short-lived. I am not expecting. I am planning for it to be short-lived. Why? Because macro is still bullish. Here we are still bullish. Long buy plays, short-lived short plays on the 21 EMA during bull markets, but I'm looking for long short positions to play out and short-lived long positions to play out in a bear market. So that's kind of the difference. It's kind of how I use trend identification to kind of plan what I'm going to do. If it's a bear market, again, I'm planning to short for the most part. And if I do get a long signal, I will enter that long signal because they are potentially profitable here. And again, there's plenty of examples. Here's a good one where it is profitable in a bear market here. But again, I would be expecting this to be short-lived as the trend is still down overall. That's kind of how I use it. Identify levels of historical relevance. Okay, that's where things get interesting here, right? All right, we got to assume, we're going to assume that blow off top didn't happen, right? We have to identify levels of significance actively every day. Anytime a level of significance is identified on a price action chart, it becomes relevant. So we're going to go ahead and apply horizontal support and resistances to some of these past price action highs and lows, right? So we got, lots of touch points. Boom. Oh, that's the wrong button. Lots of touch points here. Lots of touch points here. right? Levels of historical relevance. So we're going to see how well some of these levels line up with future price action. Probably extend that one a little bit, right? Touch points, lots of touch points. Make sure you get all those touch points. Now, again, we're pretending all that price action over here on this side of the screen doesn't exist, right? We're going into this beautiful bull market. Oh man, boom, 2,000. Oh man, boom, 3,000. Oh man, 5,000, 7,000. What the fuck is going on? Boom, 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 boom. And then we blow. And look at this. We generate more levels of historical relevance. We're gonna map them out. Again, it's an art. It's not a science. See, right here, get a lot of touch points right here. This was a clean rejection point for price action. Horizontal support and resistance is very, very, very important in identifying trend, you guys. Very, very, very important. So as I'm identifying these levels of significance here, they are proving to be significant levels here. Again, we were talking about this 2018 bear market here that led to a major, 50% decline from the all-time high to the current low, 65%. So you get a 65%, and then you get a relief rally, and you're like, well, hold the phone. This could be the beginning etchings of a downtrend, and look at this. Boom, you get a bounce up, you hit a specific level, it rejects, and then goes for another reattempt, basically falsifying an uptrend here, never really confirming as an uptrend, and then boom, ultimately coming down, generating new lower lows, breaking support, boom, back up again. Here's another significant level. We're gonna zoom in on it. Here's another significant level right here, another low. You're going to plot out your horizontal and look at that. Look at where the next series of price action reaches. Boom, it hits that resistance, rejection. Back below the 21 exponential. And this is an example where in a bear market, the 21 provided a good bullish run, a good bullish play that you could easily trade here, before exiting, essentially. But again, horizontal support and resistance will help you identify areas of importance here, and that definitely ties in with taking profit, so on and so forth. And we're going to get into that very soon. Again, horizontal support and resistance. I'm just trying to follow my list, guys. It says take profit zones. We're going to talk take profit in a little bit, but horizontal support and resistance. On a long trade, those are my take profits. Those are my take profit levels here. And I'll give you an example. When you break the structure down and you start looking at, different horizontals here, we're going to clear this chart real quick. You start seeing resistance. You're like, oh, there's resistance there. Oh, there's a low here. There's another bounce here and another bounce here. Oh, boom. Here's your ultimate low right now. Here's your new lower low. If we do see a run up, now you have resistance levels. You now have resistance levels, and I use resistance levels on a long position as take profit zones. Those are my take profits. Those are my take profit targets no matter what, level by level, right? So we get the initial break above the 21. Oh shit, warning shots fired. What happens next? Secondary candle closure above the 21. Enter. Boom, boom, take profit, take profit. And again, we'll get into that in a little bit, but just to give you an idea of what we're going to be talking about as far as take profits, identify an entry signal. That is number 3. For the bullish perspective, an entry signal is as follows. And again, I feel like I might be repeating myself over and over again, but it is extremely relevant. I want to find a clean example of an entry signal, and I think we have a clean example right over here. Where are we at? We're nowhere near where I want to be. Clean entry signal. Yep, right here. Current price action. Relevantly current. Clean entry signal. So we're going to add slope analysis into this, right? 21 EMA bull confirmation. This is an upside move confirmation. We're going to be looking at the slope of the 21 EMA and the confirmation signal of the 21 EMA. And again, this is trading without any other indicators except for price action and the 21 EMA. Here's your example, right? After this nice, nasty, medium-term time frame downtrend, boom, we hit a macro low, right? We hit a macro low, we stop and reverse. So we're going to pretend Like that price action doesn't exist yet. We're going to start by identifying horizontal support and resistance of significance, right? Boom, there's one. Boom, there's one. Boom, there's one. Boom, there's another. Boom, there's another. Boom. You can see all the touch points. Boom, boom, boom. Boom, boom, boom. Touch points, touch points. Touch points, touch points, touch points, all over these horizontals, right? All over these horizontals are touch points. They are historically relevant to future price action. Again, past market performance is not indicative of future price action, but it is historically relevant to know. So here you go. Nice little nasty downtrend. You're starting to formulate new horizontal support and resistances, and then all of a sudden, boom, you get that macro low. Right? And again, you can adjust them. You can adjust them as you go to make more sense. But you get an entry signal right here. You break the 21. The 21 is forced to a positive slope, followed by a secondary candle closure. Again, vitally important. I am a conservative trader. I am looking for risk management. I am looking for a good entry. I am looking for low risk, high reward trade setups. Clean entry above the 21 exponential. I enter right here on this green candle. Boom. From my entry to my first take profit level, 14%. But if you're trading it blindly, entry to exit, which we will talk about, 34%. Not bad, eh? Not bad. You got 100 grand on a move like that. You're looking at $34,000 in profit. Can't really complain about that. It's pretty nice, right? How do I know when to get out, Brian? I'll tell you how you know. It's the same signal, but in reverse. From a bullish perspective, boom, you get a break of the 21, exponential is forced to a positive slope, and then you get a secondary open and closure above the 21. Boom, enter. The move rides. The move stays above the 21. As long as price action remains above the 21, I am holding my long position. Boom, warning shot fired. Exponential is now negative. Gonna zoom in on this a little bit. Boom. You break the exponential. You see it clearly close below. It didn't open and close. It started up here and shot through the 21 exponential. That is a warning shot. And then what? Boom. Secondary candle closure. That's where you exit. As soon as that candle closes, that's your signal to get the hell out. And again, we'll do it from entry to exit on closure. Almost 34.5%. That's one move. On the flip side, when you see a exit signal for a long position, you have also just confirmed an entry for a short position. Slope analysis is very important for this example right here. Let's see if that's 2% at all. Yeah. Again, you would have gotten stomped out here. Again, assuming that you're using solid and sound risk management strategies, which I do. I would have gotten stomped out on this. I'm pretty sure I did when I entered the short position. But you enter the short position here, you can still set up the opportunity to take a little bit of profit on the first test of support, which is 2.5%. Quick little short trade. You can, you take a little bit of profit. I always take 50% of my position off on the first take profit zone. Always, especially on a move that I am looking to last for a short amount of time. Again, we got to remember, this is a bull market. I'm starting to lag a little bit. I do apologize. This is a bull market here, so I'm assuming that any kind of short signal on the 21 is going to be short-lived, and then boom, look at that. Macro low, confirmed right here. Another clean entry right here on the 21. Another clean entry. Again, secondary candle closure. Boom. Boom. Pull the trigger. Boom. No hesitation. It's in my rule book. No other indicator matters for this strategy to me than the 21. If I get a signal on the 21, either which way, I'm making my decision solely on the 21. That's it. That's kind of the trick of the trade here. But we got another entry signal here. And you know, you get the result here. And here's a little bit of a fake, right? We got a little bit of a closure here below the 21, but again, a secondary candle closure below the 21 is your signal to get out. It is your signal to get out. And guess what? It didn't happen. It continued to trend to new all-time highs right up here at like 67K. So, I mean, you know, as long as price action remains above the 21, I'm looking for positive price action. As long as price action remains below the 21, I am looking for downside price action. Slope analysis, we talked about fake outs and traps. Again, that's a little bit of a fake out here. This is a little, you know, again, if you know, some people are aggressive traders. Some people look at this signal here, the initial break, as the telltale sign that you need to enter a short position, and boom, if that decision was made on the first day, they would have been stomped out immediately the following day at a loss. So they really never had an opportunity to play out a short because they never waited for actual confirmation. A secondary closure below is your exit signal and your open short signal. We 21 EMA bull confirmation, 21 EMA bear confirmation. We're gonna get that wrote down. We're gonna make sure. We're gonna delete all this. Again, I want you guys to have all the information. By I should probably make this bigger. Again, I am trying to give you guys some notes, a little bit of notes. I don't like that. Fresh break. Again, entry signal, a fresh break above the 21 EMA, followed by a secondary open and closure above the 21. Right? I don't even know how to use Notepad. I wish I had Word. Exit / open short signal is the same but in reverse. A fresh break below the 21 EMA followed by a secondary open and closure below the 21 EMA. Slope analysis matters. The more positive a slope, the more confidence in the trade. The more negative a slope, again, the slope being the slope on the 21 EMA, the more confidence for a short position. Confirmation is key, okay? So I'm gonna slowly go through that. Hopefully you guys can see it. I'm gonna get Word. I'm gonna have to get Word if I want to type out shit for you guys because I don't have Microsoft Word. I just have the Notepad, so I do apologize for that, but guess what? It's free knowledge. It's free knowledge. Oh, maybe I could do this. There we go. That works. Look at that. Boom. So now what? Risk management. Let's talk about risk management, guys. Risk management is not an option. The most important factor, in my opinion, for trading is risk management, right? Obviously, there are a plethora of other very important fundamental factors to becoming a consistently successful trader over time. But the most important one, in my opinion, is learning and mastering risk management as soon as possible. There are so many risk management strategies, but the only one, again, I'm going to cover in this video is the one that I utilize for the 21 EMA. So how do I manage my risk on the 21? So first things first, we're going to talk about this short position here. And again, a lot of times you're going to come across an instance where your risk management is looser, right? It's looser. It's a little looser. And this is a clear example here, right? We get a break of the 21. The exponential has been forced to a negative slope. Warning shot has been fired. Boom. Followed by a secondary candle closure. This is an entry point. I enter right here. Now, when you take your little measurement tool, right? I always do 2% above. You're already looking at a 5% risk upon entry, right? Sometimes your risk is a little bit more. But for this strategy, you will want to adjust and manage your risk daily. If the position you are playing is going in your favor, you have a solid chance to move your stop loss into profit. Okay. If the position that you're playing is going in your favor, you have a high chance of, moving your risk management point into the profit. Okay, and I'm going to give you guys an example. Again, the current position that I'm still holding it. I'm still holding this position to this day right now on the date of December 1st, 2021 at 2:35 in the morning. I am still holding this position short. I entered here. Okay, I recognize, all right, I'm taking on a little bit more risk. I always want to tell people not to take any more than 2% risk on any trade or position, but sometimes that's not feasible. That's not always going to be the case. Sometimes if you get a clean signal, you almost have no choice but to have confidence in this signal that you have received and have confidence that you will be able to move your stop loss into a more manageable region to start. And again, this is an example of where risk management is a little high. It's a little high, right? So this is my entry point. I automatically come up to the 21 on my entry point, and I do this crazy thing, right? I do this crazy thing where I zoom in because I am I try to be as accurate as possible with my 2% stop loss, right? Or my 5% to start. Get my little tool, line it up with the 21. $2%. There's my risk. And let's see the total risk. I'm experiencing a little bit of lag. So almost 6% right off the rip. Just about 6% risk right off the rip, right on entry. But again, I have confidence with this 21 EMA moving average strategy, right? It has a more successful hit rates than not. So I took the risk, I took the position, I entered, right? Boom. As the days move forward and the position is playing out in your favor, the 21 is going to, again, for example, this being a short position, if you're in a short position, you enter here, and then you wait. Day by day, as price action continues to play out to the downside, the 21 significantly decreases each and every day. It ticks down, 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 it ticks down. Each and every day after entry. I'm gonna write that down. Oh, I already did. For the strategy, you will want to adjust and manage your risk daily. That means every day when Bitcoin closes or whatever asset that you're trading closes, you want to manage your risk. Manage your risk every day. From here, 2%. Rough. Next day, next candle. Line it up with the 21, 2%. Right? And as price action plays out, you're going to see, in this example, the 21 crosses your entry point. Now, you're at perfect 2% from your entry point. You've mitigated your risk to only 2% in 1, 2, 3, 4, 5, 6, 7, 8 days. This is an 8-day move. 8 days, 21 crosses below your entry point. Now you have a clean boom. And guess what? It continues to drop until you get to this point. Boom. You can see all the space between that horizontal and my current stop loss. It's in the profit. My stop loss is in the profit, and I have generated a risk-free opportunity for this position, for the remainder of my position. Again, I did take profit twice along the way. Most of the position was chopped off, but you can see just by utilizing the 21 and risk management here, you can easily, with patience, with discipline, get your stop loss into the green. And that's just, that's just one example. That's just one example. So, all right, let's write that down. Risk management point, always 2% above or below 21 EMA. Dependent on, I think I spelled that wrong. On type of entry. Be it long or short, right? You enter long, you want to be 2% below the EMA. Give you a perfect example of that real quick. Right over here, right? You get your entry here. Again, there's a lot of divergence. You might be taking more risk on a conservative entry, right? But when you enter, you got to recognize that there is a possibility that it could just straight up extend and never come down and give you a clean entry on the 21, right? So I enter right here. So I line it up with the 21, and I drag down 2%. There's my stop loss right there upon entry. And as the days go forward, you see the complete difference, the complete change in the 21 here, gaining all this positive momentum. And each and every day, as every single candle closes, my risk management gets better and better and better until my risk management ultimately is in the profit. It's ultimately in the profit, right? So that's kind of how, right off the rip, I manage my risk. It's always off the 21. Everything I do for my strategy is revolved around the 21. Nothing else. Obviously, I use different indicators, different horizontals, trend identification, RSI and Stochastics to add more confidence and add more strength to my positions and trades. But at the end of the day, you can trade the 21 EMA blind and be successful over time, as long as you have good risk management strategies. And I just provided you guys with a really great risk management strategy. Enter 2% below. Boom. There's your risk management for the 21. Each and every day, you adjust 2% below the 21, 2% below the 21, 2% below the 21, 2% below the 21. Each and every candle, you readjust 2% below the 21, 2% below the 21. And ultimately, based on your entry point, your stop loss will eventually be in the profit, determining whether or not the position is playing out in your favor. And again, there are examples, especially this one right here, where you might have entered on a long right here and immediately got stomped out. It's going to happen. I said, there's a 78% success rate with this strategy. That means there are a lot of percentages where it could not prove to be successful. So risk management is excruciatingly important when utilizing this strategy, or any strategy for that matter, especially if you're a trader, right? This is an investment. Right? We're not talking about investing. We're talking about trading. We're talking about day trading. Trend identification. Making money on a trending move. So, Risk management has everything to do with that. And, if you don't manage your risk, you're going to lose more than you're going to win over time. It's going to be real ugly. So, very, very, very important to remember risk management. Take profits. Take profits. So now we're talking about taking profits. We're going to go to my chart. Okay? Gonna add. Yeah, that's what I needed right there. Take profits. Profits? Perfection is not the key. It's a good idea to take profits slightly above / below your take profit / horizontal zone. It's a good idea to take profits slightly above or below your take profit zone, dependent on your position, long or short. Okay? So again, we go back to horizontal support and resistance, and I added one in because this was a region that I was looking at for take profit. Okay? Actually, it was right. Yeah, it was this right here. That looks right. That looks better. Okay. Not going to get into the fibs, but the fibs do line up, and the fibs are a good way to help me with my take profit zones. But the best way I can say it is, if you're going to take profit, like for example, you have your short entry here, boom, you have your entry. Again, if you're playing it level by level, you're already setting up take profits at the very next horizontal support down. We've confirmed a trade below the 21. Our main disposition is that price action will continue to decline until proven otherwise. And look at this. You go to your first horizontal, and again, it is lined up perfectly with your support, right? It is perfectly aligned with all the touch points, but that does not mean you want to exactly set your take profit at 56,060 spot 5, right? I want to go a little bit above, maybe 1%, maybe even 0.5% above, right? So that I can at least secure profit. I would be comfortable in saying 1%, roughly 1% above your take profit zone. I don't know what just happened. Again, let me do it again. A little bit above your take profit zone, and look at that. You got a wick. You got a wick that came all the way down, touched your take profit zone. Boom, you took profits. Bounces back up, comes back down, confirms rejection. I'm already setting up the next take profit zone. Again, a little bit above, a little bit about 1% above the blue box territory that you see on your screen, and boom, price action comes, tests it, I take profit. I'm a happy man. Right? Now, since I've taken profit on 2 declining levels and secured that profit, adjusted my risk into the profit as well, I'm looking to utilize this, as an opportunity for a risk-free opportunity, right? If I get stomped out above the 21, I'm in the profit. I'm going to get stomped out with profit. I'm going to secure profit either way. No matter which way the market moves, I'm securing profit right now. That is a risk-free opportunity, right? So we're below the 21 EMA. We are above tentative resistance and have confirmed it as new tentative support, right? But we're still below the 21. So automatically, I'm looking for entry into this blue box territory. My next take profit zone is at about 50,400. Again, about 1% from the bottom side of the blue box territory, which is a tentative support level. Take profits, guys. And it's the same vice versa on a short or on a long position, right? You get an entry here, you're going to take profit on your first resistance. Boom. And then you're going to set up your next take profit. Boom. And then you're going to set up your next take profit. Boom. Maybe even look for a re-entry point. right here. This could have been a good, decent re-entry point. This wick low, you could have easily re-entered here. And boom, more take profit. Again, level by level, you want to take profits. Level by level, you want to take profits. Take profits, take profits, take profits. Do not leave free money on the table. It's free money, right? It's not preferred for me, but you can do re-entries. You can do re-entries. I do re-entries, but they have to be fucking obvious. And I'll give you an example, right? You know, when you're looking at the 21 EMA strategy here, you're looking to nurture a tree. You plant the seed when you enter the position. Boom. Entered on 7/23/2021 at 7 p.m. Boom. You get an entry. You get an entry signal. You have not made money yet. You have not nurtured that seed. You have just planted the seed. From every day forward, you are now nurturing that seed and growing it into a tree, which is your overall position, right? Boom, you get confirmation. Explosive move to your first take profit level. Actually, take profits right here. I do apologize, but yes, boom, entry, explosive move, take profit, closes above resistance, next take profit level, boom, it hits, right? And then you see a little bit of resistance back below support, confirming it as resistance. Since the trending move is so powerful, I am looking for a re-entry point. And look at this, a back test of the 21 right here is a perfect opportunity to take all the profits you just gained from taking profit at those zones and re-entering all of them at a lower price back on the 21. You're nurturing the tree, and then you do it again. You take profit at the next level. It breaks the next level. Boom, consolidates a little bit. Boom, retouches the 21. What do you do? Re-enter. Boom, take more profit. Consolidates a little bit. Boom, right here, 8/30/2021, re-enter. As long as price action is closing candles above the 21 exponential, I am looking for bullish momentum. Boom, take profit. Ultimately, in my opinion, you should only have about 25% of your position left. But if you re-entered here, you're looking at taking about half of it anyway, right? If you have a good take profit strategy, you're looking at taking as much of that profit off the table as possible and securing it while leaving some of your position in. Again, you're nurturing the seed. You're nurturing the seed. Buying in lower, selling in higher, right? Buy low, sell high. Everybody knows that terminology. Buy low, sell high. It's kind of what you're going to be looking for on the 21, but re-entries are most of the part on the 21. Until you ultimately exit, and then it becomes reverse. You enter here on the first confirmed signal below the 21, you take profit on the first level. You might get stomped out here, but you have an entry point right here. You can enter right here. This is your secondary candle closure below the 21. Once again, that's another confirmation signal. Guess what? You enter here, boom, take profit. Boom. Fresh, clean entry signal. Take profit, blue box territory. Next, take profit, horizontal resistance. Prior all-time high. Boom, blast through that. Now you're looking at different ways of taking profit, like Fibonacci extensions, but you can use past price action history again. Not all-time highs here, but past price action here for take profit levels. That's why historical relevance is important. That's why horizontal support and resistance is relevant, because they remain relevant. Again, while past price action is not indicative of future price action, they are still relevant points. They're still key pieces of evidence for what you're looking at on a chart here. So. Horizontal support and resistance, I look at take profit zones as well. Remember to not line up your take profit zone perfectly on a horizontal because it's not guaranteed that if you do get a break that you're going to get a perfect touch. Yeah, perfect touches happen all the time. But don't get greedy. You don't have to catch the whole move. You just have to secure your profits when they're available. What's next? All right, we're going to keep this one real quick because, again, it's not too crazy here, but we're going to talk about how to add confidence. Add confidence. Number one, you're going to get your zones identified on stochastics here. 65 read bullish control zone, 50 read neutral zone, 35 read bearish control zone, right? So we're going to look at RSI first. We're going to look at this example right here, right? This example that we've basically been talking about the whole video today, right? This clean entry signal, right? We're going to look at RSI and confluence with that. We're going to crush down this a little bit. We're going to turn off these lines, squiggly lines and things. So we're going to line it up, right? Here's your warning shot. Right, you already got a warning shot on RSI that this could be a potential big move. You get a fresh cross the day before it breaks to 21 on RSI. RSI's exponential forces its way to a positive slope. Very good signal. That is warning shot fired number 1. Same signal on stochastics. Warning shot fired number 1 was a fresh cross back above the negatively sloped exponential right here. And the exponential goes positive. The stochastics goes positive, escapes the bullish or the bearish control zone, excuse me. And then you get your final piece of confirmation. Boom. You get a break above the 21 exponential. At the same time, RSI initiates a critical read above the 50. Again, the 50 read is critical. So you got the 21 breaking, the 50 breaking on RSI, and likely the 50 breaking on stochastics, which I just put these lines down. Where did they go? Break above the 50 read on stochastics, which is also being used as resistance here. So you get that signal, boom, break above the 50 read on stochastics, a break above the 50 read on RSI, a break above the 21 EMA. Now you're waiting for one last piece of the puzzle. And what is that piece of the puzzle? Boom, secondary candle closure above the 21. Oops. That's pretty much it for stochastics. You get the same signals to the downside too. All right, here's your first break. Here's your first break, boom, of the 21, right? You already have a bunch of bearish divergence playing out on stochastics and on RSI, right? So you know something's bound to break at some point. You do see negative pressure on both momentum oscillators while price action continues to increase. Something's gonna break. Guess what? Boom, you broke. What happened? RSI rejects the bottom side of the bullish control zone and floods down through the exponential, forcing it negative. That's warning shot fired number 1. Warning shot fired number 2. Stochastics rejects the critical zone. Boom, crosses the exponential, forces it negative as well. Warning shot fired number 2, followed by confirmation. Confirmation with a secondary candle closure below the 21. Boom, there's your entry point. Right, you're just looking for crosses. Boom, here's a good one. Here's another entry. Oh, we talked about that entry. No, we didn't. This is another entry right here. Boom. Deep in the critical zone. Stochastics deep in the critical zone. Explosive cross to the upside here as soon as we get the break above, right? The break above the 21 EMA, and scared the shit out of me. And then your stochastics here breaks above the bearish control zone. Boom, you got yourself a warning shot. Warning shot, warning shot, warning shot. RSI, boom, bounces off the bearish control zone, boom, back above the exponential, forcing it positive. You have solidified confirmation on that secondary candle closure. You have enough evidence on your charts to enter in a long, boom, plant the seed. All right. That's it. I do have one more subject to talk about. This video has been going on for about an hour. The most important thing outside of risk management and all the stuff that we covered in this video is this. You can trade this. You can trade this moving average strategy completely blind. You can be long-term successful over time with risk management and the 21 EMA. No horizontal support or resistance, no bullshit like that. Just blindly trading the 21. You can be successful long-term over time. Fortunes have been made trading the 21 EMA strategy blindly. right? I gave you guys a couple of examples of how stochastics and RSI is relevant. You can clearly see very, very, very beautiful signals on some of these 21 EMA confirmations here. But at the end of the day, the most important thing is to stick with your plan. I see the plan as easy as this, okay? My trading rules are very simple. If we're trading above the 21, as long as price action stays above the 21, I am bullish. If we're trading below the 21, as long as price action trades below the 21, I'm trading bearish, trading short. In either market, bearish or bullish. But again, we covered the sentiments between bearish and bullish markets and how it relates to the 21 moving average strategy. But above the 21, long, below the 21, short. Not every signal is going to strike, but if you see a clean signal and you don't take it, you're losing money. I hope I don't offend anybody when I say this, but you need testicular fortitude, heft, discipline, confidence in yourself, in your ability to read the 21 EMA, which in my opinion, it's not that hard. Trading the 21 is not a difficult process. Adding all the extra shit like I do is a difficult process, but trading the 21 blindly is not difficult. You buy on the second day above the 21 and you don't exit until the second close below. There's your trading rules. You have to have confidence that as long as price action remains above the 21, it's going to be bullish. And again, it's going to turn at some point, but if you get a clean entry and a clean exit, you're looking at profit on both sides of the ball. It takes discipline, it takes discipline, it takes discipline, it takes discipline to not deviate away from your plan. And I just basically told you how I analyze this and rue the day with profits on the 21 EMA, you guys. It's because I stay disciplined. I know when I enter a decent signal, I will do nothing but take profit until I get a complete closure below. I do nothing until that happens. And when I see a secondary candle closure below, I know I'm short until proven otherwise. And that only proof otherwise would be a secondary candle closure above. You guys, anybody watching this video, I'm not a financial advisor. This is not financial advice, but this strategy is so fucking simple. It is so fucking easy. It is almost too good to be true, especially in assets that are as powerful and as fluid and as liquid as Bitcoin. You cannot go wrong, in my opinion, with this strategy. Again, there are examples of where it doesn't work. It happens. It happens, but with proper risk management, you can evade complete failure. If you take profits, you will evade complete failure at all times. These are the fundamental factors on how I run my 21 EMA strategy, you guys. I don't deviate from this plan. I feel like I was all over the place because there was a lot to fill in about an hour video, but I think I got it all. If anybody has any questions, comments, or concerns on how I do this strategy further, let me know. If anybody wants me to talk about it on the stream, let me know. But that's going to do it, ladies and gentlemen. That's it. That's the instructional video. I hope it was helpful. It was helpful to me. It allowed me to dive deeper into my own strategy, and I got to learn a lot as well. So that's it. That's the season. Thanks for coming. Thanks for being here. You guys know what it is. Just being a little bit goofy. I'm excited. I really hope this helped you guys. If anybody's looking to trade this strategy, I really hope it helped you. Again, this is coming from, in my opinion, I'm still kind of a newbie in this business, but I am learning and I am growing and I am getting more profitable over time because I am staying disciplined and I am sticking with my strategy. I stick with my strategy and that's it. So that'll do it, everybody. That's going to wrap it up. Thanks for coming along. If you're new to the channel, you like what you see, hit that like button, hit that subscribe button, tick that little bell. And until next time, everybody, you know what it is. Stay safe, stay happy, stay healthy. Peace.